Well, hello, everyone. Welcome to our Silicon Heartland show. It's our series on the Midwest. Today, we have joining us from Cleveland. We have Scott Shane from Comeback Capital. Hello, Scott. How are you?
Good. How are you doing?
Good. So happy you could join us today. Really appreciate it. You're doing wonderful things in Comeback Capital, and we're going to hear all about it in a few minutes. So let me just make a few introductory remarks for those who are newcomers to our show. We have been doing the Heartland series. This is our third one. We were in Pittsburgh and we were in Indianapolis before. We're going to Columbus and we're going to Morgantown, West Virginia. We're going to Tulsa, Oklahoma. And so on. Louisville probably too. So we're circling the Heartland with this series of AskAVC shows. Now on the show, you can ask Scott or any of these VCs who are coming up questions. So you get to have direct contact with them, just as long as your questions are really relevant to VC and the topic that Scott's talking about. So a little bit about the Heartland as I've pictured it on my journey. For my new book, Silicon Heartland, there's the map of all the places I went, and there's the car that I went in, the Honda Element, which logged about 10,000 miles. I used my base in Lancaster, Ohio, which is very near Columbus and near where the Intel site is. I have been to the Intel site, and there's a picture of the Intel site under construction just outside of Columbus, 30 miles from my hometown. I also visited some other great landmarks like the last remaining steel mill in Pittsburgh, and that's me standing in front of the Carnegie plant from years ago that's still operating. This is my fourth book, Silicon Heartland. I've been on a journey throughout Asia, China, India, and now back to Silicon Valley and Silicon Heartland. It's my home area. I'm from Lancaster, I'm from Ohio, and I'm glad to be reporting on what's happening in the Midwest as these new tech hubs arise. Now let me say a little bit about Comeback Capital. I interviewed Scott for my book, and he told me about the Rust Belt tour that Comeback Capital was doing, and how that led them to launch a micro fund, and it led them to invest in 40 tech startups. So it's pretty amazing. We'll get to hear more about what kind of tech startups those are in a minute. So Scott is a professor at Case Western Reserve in Cleveland and has his PhD from Wharton. He's also an entrepreneur in residence at Youngstown Business Incubator. So at this point, I'm going to stop the share. And what I would like everyone to do is to get your questions ready. Now, for Scott, you might want to ask me a question or two, but this is mainly for Scott. And get your questions ready in the chat and just type them in. I'm going to be watching them, and we'll pick out the best ones. So thank you very much for joining us. I appreciate it. And I know Invest Hong Kong is on the line as well. Thank you for your support. So Scott, tell us about Comeback Capital. How are things going?
Well, things are going really well. Actually, ironically, the market turning to be a bit of a downturn is to our advantage. It works to our style of investing. But maybe I should actually give a little bit of the history or the origin of the fund, because the fund itself has an interesting starting point. So back in 2017, Patrick McKenna, who was an entrepreneur and a investor in early stage companies, led a trip of Silicon Valley, mostly executives, to the middle of the country and to interact in places like Cleveland and Flint and Detroit, et cetera. And then the following year, he turned this over to Roy Bahat at Bloomberg Beta and Bloomberg Beta started organizing the Comeback Cities tours. And this is the whole idea. They were going to take a bunch of New York and San Francisco and Silicon Valley VCs,
Yeah.
bring them to the Heartland
Right.
to look at opportunities. And so that was, in fact, I was out in Youngstown, asked to meet these coastal VCs. There were a bunch of big funds represented, probably something like $8 billion of capital under management represented on this bus tour. And then that interaction led to the creation of a fund to basically invest in the very early stage companies, but in the flyover states.
Okay, so this bus tour reminds me very much of how China got its start from Sand Hill Road. I wrote about this in my first book, Silicon Dragon, about how one company hosted a bunch of VCs to come over and see what was going on in China. And then they began to invest in China. And then they started setting up funds in China and hiring people in China. And that was Sequoia Capital. And that was Mayfield. And that was NEA and Kleiner Perkins, all the major firms. This is going back about 12 years. Well, maybe a little bit longer than that, 15 years. But I think they have, some of them made a lot of money by being early to China. And now Comeback Capital is new to the Heartland and you're early.
Yeah, and to be honest, the idea here was to solve two economic problems of investing in early stage companies in the Heartland. The problem number one is if you're a VC at a big fund like Founders Fund, for example, and you have more than $1 billion in capital under management, you can't bother to look at $500,000 pre-seed deals in a city like Indianapolis or Youngstown, Ohio, or Minneapolis or anything like that, because the opportunity cost on your time is too high. So they invest in us and use us as a scout fund so that the companies that we've invested in that take off and grow bigger, that are raising more sizable next rounds, they can build a relationship with. The second economic problem is that if you are an angel investor or a family office and you sit in a city like Pittsburgh or Memphis or Louisville, the local deal flow is too small to support making money in the activity. It's not as if you sit in San Francisco or New York City where there's a high volume of this activity. So by investing with us, we pool, in effect, deals that come from our different LPs from all these different places and share them back to those LPs to sidecar with us. And that is what solves their deal flow problem. So we're really solving for two deal flow problems at the early stage.
Yeah, that's a good strategy, I think. So who are some of these LPs? I think Bloomberg is, right?
Right. So the big origin group behind this effort was Bloomberg Beta that kind of got this started. And so they're an early advisor. So Cyan Bannister is also an early advisor of the fund. At the time that we started, Cyan was part of Founders Fund. Now Cyan has got her new fund called Long Journey Ventures. Yeah. And then we have, so we have a bunch of these people from larger coastal funds that are using as scouts. Then we have people from the middle of the country that are high net worth individuals that are investing. Now, the other thing that I think is a bit unique about how we approach this is that there are 4 partners in the fund. And unlike a typical venture capital fund where the general partners might invest 2% of the capital, 40% of the capital of Comeback Capital is the general partner's money. And so we are a little bit more of a cross between a family office or angel investors than a true VC fund. And that matters in the sense that there's many things that venture capitalists do that are probably not the most productive things for generating actual outcomes with companies. One of which is to always be seeking to get markups from a next round of financing so that you could tell your limited partners, well, it's only been 3 years, so we have no distributions yet, but these next round of VCs are valuing our companies at higher than what happened before. The truth is that a paper markup on what somebody would pay to invest at the next round is not really the goal you're trying to achieve. The goal you're trying to achieve is build companies that themselves are successful and people buy them because the companies are so good, right? And so by taking out a little bit of the financial markets gaming of VC, I think we make for better decisions.
Right. So what do you think about these unicorns, all these unicorns that have been financed in the past couple of years, and now they're facing some challenging times, aren't they, with getting another round of financing?
I mean, this is the whole problem of what happens and where the markets are effectively freezing up in many cases. So you have a bunch of people who raised money at very high valuations. The current investment climate, they're not going to raise money at those valuations. So what can happen? Either they have to do a down round financing, which is very difficult to pull off because it's very difficult for people to accept that they overpaid for something, right? And for the founders to even take a paper reduction in their value. The second thing that it happens is that now you start putting in terms in the next round of financing that will tweak the returns for the new money that comes in to the disadvantage of earlier investors, and in most cases the founders too, which is unfortunate. And then the third alternative is that literally the market freezes up and transactions don't happen. People say, we're just not going to do it.
Right. So are we seeing any unicorns in Ohio yet?
So we've seen a couple of unicorns. We saw my friend Tim Schickel at Refinery Ventures has one. He invested in Astronomer. That's a unicorn. We had several successful exits of companies, and we have several near unicorns. I mean, the ironic part about the question is, are they all unicorns today? They were unicorns when they raised the last round.
Right. So several are facing challenges, like Root in Columbus.
Yeah, well, Root is now, been an exit for the early investors, right? Now, the current stock price of the company is not so great.
Right. So if you're Drive Capital and you invested early, you did okay.
Well, they sold presumably at the IPO. That's the norm.
Well, yeah. If they didn't have a lockup, I guess that's true, right? So, what are you seeing? What are the kinds of tech startups that you are seeing in the Midwest that take hold?
So, as a general rule, entrepreneurs start companies to solve problems that they're familiar with. And the problems are different generally in the Midwest than in, other parts of the, country. So for example, we see a lot of logistics, trucking, software for those kinds of industries. We see a lot more manufacturing type startup software for that supply chain, things of that nature. We will see much less and also InsurTech and certain kinds of fintech are also pretty popular in this part of the country. We see a lot less of is consumer internet types of stuff because that's not the industry in the area.
That's Silicon Valley and LA mainly, still, and maybe a little bit of Austin too. So which market in the Midwest do you think has the best traction so far?
So it's hard to think about this in terms of states. I would have to think about it in terms of cities because they're different. So we see the most vibrant startups in the Midwest coming out of three cities: Columbus, Pittsburgh, and Indianapolis. Those are kind of the most vibrant of the markets. We see, but those are not actually necessarily the best ones for us to invest in. They're just the ones where there are the most VC backable startups.
Okay, so what's driving that in those three cities?
I think there are a couple of things. One is that there's, in general cases, been some exits. And so there have been some angel money that has been released, and founders that have become now investors, right? That's one part of this.
Yeah.
The other piece is that there have been corporate VCs in the marketplace that have supported investing in companies. And while they'll invest in companies in their industry and wherever, the fact that they are present and located there means disproportionately they'll look at local companies. So I'm thinking about the presence of places like a Nationwide in Columbus, or Heritage Group Ventures in Indianapolis, as really helping those ecosystems. I think that's the second. And then the third is the talent that locates in the places. So it seems like there's a lot of tech and business talent in places like Pittsburgh and Columbus and Indianapolis, much more so than in some of the other cities in the Midwest.
For instance, Detroit or Flint, or
for instance, Detroit,
Cleveland?
Flint, Cleveland, also more so than, in my opinion, in Cincinnati or Milwaukee. I mean, there's great companies that get founded in all of these places, but Columbus produces a lot of software engineers out of Ohio State. Between Carnegie Mellon and Pitt, there's a lot of talent that gets produced in these areas. And to be honest, a lot of people don't want to go and live in the Bay Area, and even if the salaries are a bit higher, the cost of living is so much higher, and the stress and the pandemic has really shifted the movement of people back to these kinds of places.
Yeah, so you're seeing people moving in from other locales and settling in places like Columbus and Cleveland and elsewhere?
Yeah, one of the things that is driving a lot of this is a lot of companies are creating second offices. That's a driver, in particular in Columbus, where you have second offices. Now, I mean, this isn't unique to the Midwest. For example, a lot of the growth in Salt Lake City's startup ecosystem comes from the second offices that came from the San Francisco-based companies. It's just that what happens is there'll be a second office, there'll be some talent there. Eventually there's an exit. Those people are now there because they were there for the second office. They start companies, and then the ecosystem grows. Yeah.
Okay. So there is a venture capital gap in the Midwest, and how can that be addressed?
So one of the things that there is a solution to the lack of capital is a lot of generating the connections and network to the next rounds of financing. I mean, this is in essence what our comeback capital does. I refer to our approach as we are a first grade teacher. Our whole goal is to get people into second grade. We only focus on the things that matter for that. So if we're investing at the pre-seed, this is the people who are doing maybe a seed, maybe the Series A rounds of the companies. And so that's one part of getting more capital, is getting the connection to the next round of financiers and getting the companies in front of them. A second thing is the open networks and syndication. So we see a lot more. So our deals, we will frequently be investing alongside of other VCs that are not from, let's say, the kind of Midwest or they're from the outer Midwest. So Bread and Butter Ventures in Minneapolis is a frequent co-investor. Right Side Capital Management out of San Francisco, frequent co-investor. And so the co-investing is a second way that helps to fill the capital gaps. And then there are others. There are some good, well-designed government programs that kind of create leveraged funds. Like we have an Ohio specific fund that's a leveraged fund where we have a match of state loan dollars to us for every dollar of equity capital. That creates an additional value. So those are some different ways of closing the gap. But there's no question that the shortage is more on the capital side than on the entrepreneur side in the Midwest.
Well, are we going to start to see more exits now that will drive the returns and cause the coastal investors to take another look and maybe start investing more readily?
I mean, we're over the past, so if we go back and take a long enough horizon on this, right? So if you go back to the early 2000s, it was much, much worse, and there was much less. And we've had some exits and we've had some growth in that activity. The part that's difficult about this is venture is subject to these power law distributions, right? So people have a portfolio, maybe a fund has 20 companies in it, like 2 companies are going to count for almost all of that return. So if those 20 companies are like in one fund, are distributed across the whole of the Midwest. Well, where did those 2 companies, where did those 2 startups that had the exits that generated the value? If they're in Ann Arbor and and Kansas City, well, then you're going to get something there. And the other 18 in other cities, you wouldn't have gotten anything from that.
Right. So where do you see this going? What is the landscape going to look like in the Midwest in another 10 years? Intel is coming in, they're carving up a lot of agricultural land. Google and Facebook have come in. There are all these tech clusters forming. What is the tech landscape going to look like in 10 years?
So, from my day job, I spend a lot of time looking at patterns of the overall data. So we saw a concentration of venture capital in the centers of venture capital. Probably the peak was probably around 2016, 2017, right? Yeah. I consider that trend coming down, right? So that was where so we saw more and more concentration going into San Francisco, Silicon Valley, New York, and Boston, right? Leading up to that. And then since then, we've seen it moving away. I think that trend is going to continue, and we're going to see many, many, many small centers. And those could be, from Austin to Miami to Columbus to Pittsburgh to Indianapolis. There'll be a lot more small ones. I don't think we'll end up with the next Silicon Valley concentration being Pittsburgh or Columbus or something like that. I think the model is shifting.
Okay. So in the Midwest, one of the things I noted, and you already mentioned it, is the government factor. How the government is behind a lot of the initiatives to support startups. And this is a difference to me than Silicon Valley's model of private enterprise. How important is the government in supporting this Midwestern tech rise?
Well, so first of all, I sort of think that it's not quite true. The government was pretty important in the early days of Silicon Valley, right? Yeah. And so when the ecosystem was getting started, that mattered a whole lot. The thing is that in the early days, it's too easy to have 2 things happen to capital. One of which is high net worth individuals take their money and they send it to where the opportunities are to invest. And so if all the startups are in San Francisco, some enterprising VC will go find all the rich families of Ohio and go get their money and invest solely, within 15 miles of Stanford, right? Like, and people have done that very model, right? And so part of this is, well, what can you do to encourage more of that local investing? The other way it's really fragile early on is that, you know, great companies look just this side of being stupid when you're making a decision to invest, right? Like one more millimeter and it's a terrible idea, right? And so part of this is, if you can make things a little bit more attractive to the investor at the margin, you can push a few more people over to making those investments. And in many cases, investments become a self-fulfilling prophecy or generate a system. I'm going to tell you a story of a company we invested in called FloatMe, right? I mean, this story isn't completely told yet, but it's a good example. So back in 2019, the Venture for America had its accelerator in Cleveland, and this company was founded by people who had done Venture for America, and they were in doing the accelerator. And there were maybe 150, 175 people at the demo day. And here was the problem. At this demo day, 175 people, there were maybe 4 check writers in the whole room, right? Lots of cheerleaders, lots of supporters. But we got involved, made an early small investment, got a couple of other funds to make early investments. The company started taking off. It, about a year later, raised several $1 million seed round. Then they just last December raised a $17 million Series A led by the Foundry Group. Now, the point of the story is that the Foundry Group, you know, Brad Feld, Jason Mendelson, those set of folks, there was no way they were going to ever see this Cleveland company at the beginning and be in the room, right? But when the company got developed, then there's an opportunity. And to me, that is what the early stage activity means in the Midwest. Now, we benefit in the sense that there's markups, right? So my LPs will benefit from that, but that's the system we're playing. That's a very different system than you would play if you were in New York City.
Yeah. Well, tell us a little bit more about some of your other startups you've invested in.
Yeah. So we had a couple of other very interesting ones that have taken off in similar matter. So we invested in Path Robotics, which is a company, and this is an interesting statement about ecosystems too, right? So I discovered them doing a student startup competition in the basement of a Russian Orthodox church in Akron, Ohio, right? I mean, they effectively blew away all the student competition. They got some Silicon Valley investors to lead around. We invested in them. They were operating in Cleveland. They raised a Series A from Drive Capital and moved to Columbus. And now the main reason they moved to Columbus was they couldn't hire enough tech talent. They needed, you know, software engineers. They couldn't hire the volume in Cleveland that they needed. So they moved to Columbus where the hiring was easier. And I mean, this is a statement about these ecosystems. Now they subsequently have raised, you know, Series B and Series C and in the hundreds of millions of dollars. Now they're a, you know, sort of high profile, well-known startup, but, you know, they weren't on day one. Nobody is on day one.
Right. Exactly. How important are politics in the development of a new Silicon Heartland in the Midwest?
I mean, I don't. So I would make the statement that policy and government support is important, and politics are difficult for everybody, right? Because you can generally get a bunch of people to agree on some policy or enough people to make the policy happen. You know, I think politics is a drag on all of it.
Okay. All right. So I understand there's a pretty tough race going on between JD Vance and the fellow from Youngstown.
Tim Ryan,
Tim
Congressman
Ryan, yes, I have blanked on his name. Yes, Tim Ryan. I interviewed him for my book, so he's in the book. But yeah, so they're both have Rust Belt origins. It could be really interesting to see how that all plays out for the development of a Silicon Heartland. Agree or not agree?
Yeah, I mean, absolutely. I mean, I want to, keep the politics part of it out of this. I think that the interesting thing is that, when you're talking about activities in places like Ohio, all those people are, generally from there. What I think is interesting about that particular race is you have two people who know a heck of a lot about high-tech business building activity, which is in general kind of unusual in politics.
Yeah, no, that's true. What percentage of your fund is invested in Ohio startups?
Well, so we had an initial demo fund, right? That initial demo fund deployed its money between 2018 and 2021. Then we have a current fund, which is structured as a rolling fund that is only 1 year old. The rolling fund just started in July of 21. Then we have a separate Ohio specific pre-seed fund that I was mentioning before, that started in July of 2021. So the rolling fund has only one later stage company in it from Ohio, in part because the pre-seed fund has 7 companies in it. From the Ohio pre-seed fund has 7 companies in it, and they're all from Ohio by definition.
Okay, and you've invested in 40 startups, is that right?
I mean, by now, across the 3 funds, we're probably I think we're at 48.
Okay, so your pace is about 1 a month or so?
Yeah, so we think about this as we target trying to make 3 investments a quarter, and then we end up averaging maybe every couple of quarters, we might pick up a 4th. That tends to be the pace.
Yeah, okay. And what's the average size investment?
So we write $250,000 checks. And when we do this, what we're primarily investing in are kind of rounds that are $1 million or less, where our LPs are generally sidecaring into those investments. So we have an average of about $3 of LP sidecar money for every $1 that we're investing. So, think about this as, if it's $1 million round and we're putting in 250, the LPs combined are about 750. Averages don't really work terribly well because sometimes there's a hot company and the round is bigger, and sometimes we'll go to other funds to fill the gap because our LPs were not interested in that particular company.
Okay, that was one of the questions from our online attendees, but there's another one as well, and the question is, do you have any potential power law return companies or 100x return in your current portfolio?
I mean, okay. So keep in mind that the earliest companies we have are from September of 2018, right? So it's 4 years, right? To kind of right now. We have companies that are currently marked up 25x from on their last round, which might have been a year or 2 ago from where we invested. Our belief is that those companies might very well generate 100x. At least the last round of investors
Yeah,
certainly hope so, because if those investors are not investing later and they're not getting 4x on their money, they're going to be unhappy.
sure. Are you planning any more bus tours of venture capitalists in the Midwest?
So it's interesting. I mean, COVID really created a lot of problems for this. So we did one in the Southeast, and then we did one in the Midwest, and then COVID hit. Part of the thing is that the COVID also changed the attitude of many VCs. So pre-COVID, you couldn't get VCs to easily consider evaluating companies over a Zoom call, right? We didn't think much of that. We always did it that way, so we didn't think it was a big transition. Now that people have become accustomed to investing that way, there's less interest in doing these kinds of tours. Now we're finally back to doing conferences and other in-person events, but bus tours still not planned yet.
Okay, well, you have a conference coming up next week.
We have a conference
in Columbus.
We have a conference coming up in Columbus. So what happened was we had, done a 2019 conference. We were planning a 2021. Obviously that didn't happen. 2020 didn't happen. 2021 and 2020 and 2021 were virtual events that we did. And we're finally back to doing something in 2022. And we're doing Columbus, same, connecting the coast to the heartland, 1 day conference. We're looking at 175 investors and 175 founders at this. Then our plan is in early May to be back to doing this on the normal season, right? So doing it in October is a terrible time, by the way, to do a conference because all your sponsors are out of budget. But go back to doing that. And we're looking very much at doing something in somewhere like Nashville, because we think that that's a very good and interesting market for venture stuff. And we see a lot of deal flow from there.
Yeah, sign me up for that. I like Nashville.
Absolutely.
I'm going to be interviewing one of your partners at the Comeback Capital Conference next week, Phil Hagerman from Flint.
And so this is interesting. So we're an interesting fund also because I've got two partners, Phil, who you mentioned, and Patrick McKenna, who are more entrepreneurs than investors, in the sense that, Phil, took a company public on the New York Stock Exchange. Diplomat Specialty Pharmacy took public in 2014. Patrick built several companies that sold for a lot of money. Each of them has an existing company operating. I think this is very good. This is another source of what we think may be different about approaches and the approaches that are necessary in the Midwest. Having two very experienced operators making investment decisions and evaluating companies and helping companies can provide a kind of help that you don't get just from investors. And that matters more when you have inexperienced founders, which you disproportionately have in the Midwest, because we don't have third-time founders doing a lot of deals. Most of them got sucked away.
Sucked away to what? Silicon Valley?
So Silicon Valley. I mean, I've had several, early stage companies that we knew got started in Cleveland, but, they needed to hire talent. They needed investors. They moved to San Francisco in 2015 or what have you, and they exited the company, and now they're starting their next company, but now they live in San Francisco. So the next company gets started in San Francisco.
Right. Okay. Got it. Now, another question came in. Can you share what impact Comeback Capital is seeing in relation to ESG?
So when you say the impact due to ESG, I'm wondering, maybe we can get the, get that clarified. I'm not sure that the ESG is directly impacting comeback capital. We do see a bunch of ESG opportunities that
Yeah.
seem to be larger in the Midwest. And part of
Okay.
that's because, you know, if you're talking about things like adherence to environmental regulations or things that are changes to problems, you know, you go where the water was bad, like Flint, you go
Yeah.
where the companies need to fix the problem. So those opportunities, we see a lot of the software being applied to solving those problems.
Right, right. Yeah. And that's the interesting thing about the, can I call it the Rust Belt? It's that there are a lot of problems to be solved still. So there's good opportunities for tech startups to be innovative and help to solve them. And then you can finance them.
So I think that there's also two other dimensions of this, right? So people have talked about, people way more famous than me, right, about the importance of software transforming a number of industries. I think that if people aren't operating in industries and seeing manufacturing up close, or seeing trucking up close, they don't realize the degree to which people literally use paper and pencil checklists today and walk around a plant, or that a trucker carries paper invoices and things in the truck, that these things are so ripe for these productivity changes with software. And we are seeing a lot of that.
Yeah, all these SaaS software startups like High Alpha has so many of them in all kinds of fields. And yeah, I think that is true. Even I see a difference between Silicon Valley and New York. People use paper money in New York. There's no paper money in Silicon Valley. It's just one example.
But like, here's the example I give to people. I think it's important. If you go into a manufacturing plant, you will see equipment with dials. You will see things that date from before the computerized machinery. So what people are doing, and where there are very good business opportunities, is to come up with some kind of device that collects the core information off of the machine, turns it into data, and then provides that kind of advanced software solution to the problem. The opportunities are so ripe. There's so much room there, leaving alone things like, cleaning up water and, polluted sites and things like that, that require other kinds of technologies to do that.
Right. So there was a follow-up to the ESG question. And the follow-up is, how are investors responding to environmental and social governance? So
I think that what you're seeing is that so I'm going to say this as venture investors. Venture investors like any solution that people can come up with where the customers will buy. The ESG regulations are requiring people to come up with solutions, which is pushing the big companies to buy these solutions and being concerned about this. And if the sales are happening and the companies are growing, the investors like that. I don't think the ESG is unique in that regard. I think it's the same as if you're selling somebody some other kind of software for managing machinery, or a new piece of equipment.
Right. So I'm thinking of Detroit and their whole premises around the industry 4.0 and bringing in IoT. And then I'm thinking of Youngstown with the 3D printing, advanced manufacturing. These are fields that seem to be very much a part of the heartland, and it can take off there that they might not have ever seen any traction in Silicon Valley, or very little traction. It's a manufacturing base. You're dealing with an industrial base. So you are starting with these kind of companies that you need to, like you're talking about, get into data, get into software, get into AI.
And the
Yeah.
other parts are that so, we've looked at very interesting companies that come out of the, in this space, right? So now people might be three-dimensionally printing parts. Well, what's the part that is going to give you the best ROI if you three-dimensionally print versus a traditional method of making the part? So some smart entrepreneur comes up with a piece of software that's going to measure all this in real, very quickly in real time. And you can say, push a button, and you'll be like, well, these 6 parts of your, product should be printed with 3D printing. These ones should be done with traditional methods. And you could sell that to a manufacturer, right? In that process. And so there's all these applications lead to other things that this is, now we're leaving out other things that are present everywhere, but also heavily present in the Midwest. So, our healthcare system, takes up a very large amount of GDP, and we need to, there's many problems in it. So there's all kinds of insurance businesses, and there's all kinds of, efficiency of scheduling software and running ER operations. And then there's things related to the actual medical devices that people might come up with that solve problems. Then there's agriculture, right? And the support of making agriculture and ranching, more efficient, right? I mean, the thing that I always point out is that nobody has a farm or a manufacturing plant in Manhattan. So there's no way that you're solving the problem of a Manhattanite today in those businesses. But you can in the middle of Ohio, and you could do it from Columbus because it's not very far to where there's a farm. It's not very far to where there's a manufacturing plant.
Yeah, and I'm reading that Nationwide has some new initiative with ag tech.
So so from an insurance perspective too, if you're in the insurance business, there's you want to support a bunch of ancillary kinds of industries where insurance is necessary. But, there's all kinds of business productivity opportunities in agriculture, and ag tech is a big place for those kinds of things.
Sure.
So is education, by the way, is another one, right, for this activity.
Yeah, I'm thinking of Duolingo out of Pittsburgh with the translation software. That's another one that went public out of the Heartland. But now I'm also thinking about Cleveland. You're in Cleveland, and you're right next to the Cleveland Clinic. And there are a lot of spin-outs from the Cleveland Clinic and also from Case Western. Now, this is giving Ohio and the Heartland a biotech advantage, isn't it?
Yeah, now our fund we do not focus on medical devices or drugs or in that space. Now, there are other funds that do those kinds of activities. So our interface with places like the Cleveland Clinic or University Hospital System or things like that are largely, we've invested in companies that are fixing the whole medical scheduling system, right? Which is, very, very difficult. There's great opportunities there. Then there's opportunities in the whole insurance space, right? With, ICHRA policies, individualized, healthcare choice, these kinds of things. So there's a number of ancillary related activities. And there are plenty of people doing great things with, the true healthcare innovations, just not us.
Right. So I've been writing for CNBC lately a lot about the Heartland. I wrote about how Kroger has really gotten into robotics and automation, following the lead basically of Alibaba in China. But Kroger, a traditional grocery store, has become very digitalized. The same thing, P&G has a lot of innovation spinning out. And then Goodyear with tires, they have these new airless tires. So it seems to be a lot of innovation around the corporations, and there are many of these big corporations in the Midwest. Any comment about that? Are they having an impact in what you're seeing and what you're doing?
So I think that the corporation's impact in the Midwest is much bigger than it is in other places. And part of that's because some of the biggest investors in a given state in venture capital are the corporate investors. So for example, in Indiana, the Heritage Group takes $50 million a year off its balance sheet to invest in startups. They have their own startup accelerator that they run.
Mm-hmm.
They are the equivalent of a $350 million venture fund, which makes them pretty big for Indiana.
Mm-hmm.
Goodyear is corporate venture activity is pretty substantial. It is on par with other large companies, but located in Akron, they are by far more important than any other Akron, Ohio-based venture firm. I don't know that there is a, more than, minuscule other venture activity from Akron, Ohio, from an independent VC.
Right. So when I was on my Heartland tour in my Honda Element, one of the things that struck me was that when you would go into these Rust Belt cities and you would see a lot of the abandoned factories or the abandoned corporate headquarters, like in Detroit, the old Packard plant still standing. Flint basically tore down Buick City, so that's not there anymore, but it's just a black hole. Pittsburgh is in transition. Some parts of it are new and some parts are real old. And it's kind of sad to see the state of industry that went overseas several years ago and caused this downslide of the Midwest, which was an industrial base and a huge industrial base for the world, and then kind of lost that. Okay, so any comment on what I just said?
I mean, it is unfortunate. I think the reality of things are, because we see this in places like Cleveland all the time, it doesn't pay to retrofit and get rid of the asbestos in the old mechanical manufacturing buildings that were there. So people, when they do something new, they just build out in the suburbs or the exurbs, right? Like that's just the reality of it. It's unfortunate. We don't have a great system. We probably don't have the right incentives
for downtown.
For
Yeah, for downtown. Dan Gilbert's done a good job in Detroit, but there's only so many people like that. And Flint, Phil Hagerman in Flint, but there's only so many people like that. You need a whole group of champions. Okay, there's another question here about if your firm invests in software as a service for 3D, and do you invest in the metaverse?
Yes, in fact, we're probably a little bit high on investing in both the metaverse and this kind of blockchain activity. So we have several different kinds of things in that space.
Why are you so active in that space?
Well, so part of it is that we're always looking for the big opportunities where things, when you're really early, the most likely outcome that happens from our investment is it goes to zero and we lose the money, right? So what we want is the chance that it could be really big. Well, how do you get to be really big? You're doing something that everybody else isn't doing that's new. And in particular, you're doing something that's more the pipes and plumbing of whatever your problem you're solving. So we are very interested in finding people who are solving fundamental problems with blockchain or fundamental problems in the metaverse that couldn't have been solved some other way before, that, I don't know, transform gaming or transform identity or transform payments or something like that. And what has been new in the recent years? Well, one of the things that's really recent new is things like distributed ledger technologies and the metaverse, right? So that's why we have placed a bunch of bets there.
What can you talk a little bit about those?
Yeah, absolutely. So I mean, we have a company that is actually out of South Carolina that had figured out a way that you can do payments that are adhering to regulations about not pooling, but use the blockchain to make it easy for people to act as if they are pooling funds. And that is really good for anybody who wants to run raffles or things like that, right? That this was the whole obstacle. So that's an example to us of something fundamental. Like, you can't do Venmo that way. You can do it. Venmo cannot solve that problem because it can't be pooled under the regulations. Another example is that we have a point and click drag and drop animation company, and they are working heavily on esports avatars, right? And the whole idea of people creating avatars and making the avatars something that anybody without any kind of ability can create themselves is a novel, broad opportunity, right? We like things that look like that.
Okay, but is the field overhyped?
Is the what?
Is this field overhyped?
Every new technology is going to get overhyped until somebody has this really fundamental breakthrough, and then we look back and go, that was transformative. Because like everybody says everything is going to be really great and transformative, and some things are.
Yeah, that's true. What's going to happen to all the internet content when we have the metaverse?
I don't know. That's like, this is one of those things where I'm like, I don't know enough to know, right? I'm not the technologist who could tell you the
It's
answer.
a known unknown, right?
Right.
Okay, all right. Now let's see. Let's see what else we have going on here. I don't know if we have time for the poll, but I'll launch it quickly. And I'll read off the questions, Scott, and you can answer them too as we go along. Our poll, 3 questions, and just log your answer in here. It's totally anonymous and just for fun. Has Silicon Valley shifted? Yes or no? We got a lot of choices there. Is SF over? San Francisco over? I keep hearing that. People say, is San Francisco's over? Is it over? Yes or no? Where is the next Silicon Valley? New York City, Austin, or Columbus? Okay, now Scott, let me ask you, has Silicon Valley shifted, yes or no?
Yeah, I think that what we've shifted to is we've gotten rid of a single Silicon Valley, and now we're going to have lots of them.
Okay, lots of them. Okay, yeah, okay. So, well, a lot of people on here said Silicon Valley has not shifted. So this may be a bias from our audience on here. Okay, is SF over? Well, about 20% yes, and the rest are no. And what about you, Scott? Do you think San Francisco is over?
No, I love San Francisco. I think it's still going to be a great place. I just think it's not going to be the center of the startup world like it had been a few years ago.
Right. Okay. Where is the next Silicon Valley? Now, a lot of people, 60% said New York City, 40% said Austin, and no one said Columbus. So
yeah, I'd answer that question with a write-in, and I would say everywhere.
Everywhere? No, but there are these places that are left out, like points of Appalachia left out, where they don't even have the internet.
Yeah.
Everywhere
Okay.
there's
So
there's all the ingredients that are required.
to be precise, I would say everywhere that there's a reasonable city, we're going to start to see startup ecosystems that look
Yeah.
like mini Silicon Valleys. I think the model of concentration has been broken.
The model of concentration has, okay, yeah, it's like 75% of the money going to the three
Yeah,
coastal hubs.
the peak that it hit was 85% of the capital in 3 metro areas, right? And that I think we're not going to see again.
Right. Now, what about looking at this from a global angle? Does Asia have an impact in the heartland? And if so, how?
Well, I mean, it's always, there's a competitive angle on this. So lots of our startups do that. We don't invest outside of the US, so we don't really know, and I don't pay a lot of attention to the investment climate there. But I will tell you that there's people in Asia competing pretty much with every startup that we've invested in.
Oh, really? That's interesting. Okay. That's good to know. So I'm moving right along on the shared screen, and we're about to wrap up. So I just want to say thank you to Scott for joining us. Thank you everyone for asking good questions and listening in. We hope to see you for our next Silicon Heartland show, which is coming up in a few weeks. The next one will be actually in Columbus with Rev1 Ventures. Next week, I'm not doing a show because I'm going to be in Columbus with this conference that Scott's putting on. So in the meantime, please help support what we're doing. We are not a nonprofit with a lot of money behind it. We are a media entrepreneurship run by Rebecca. Okay, so please join our Silicon Dragon Ventures. You can go on our website, check out everything we're doing, and you can check out the video replays of our prior shows as well. So please do that, and don't forget Silicon Heartland. It is a book too, as well as a region. So, okay, Scott, thank you again, and I look forward to seeing you in Columbus next week.
Thank you. Bye-bye now.
Thank you. Bye-bye.